Peter, you there, Peter?
Yes.
Peter, can you hear me?
Yes, Peter, back to Bill. Over.
So this is really the flipping houses for rookies, but we're underground today because of the topic we're going to talk about. So I don't want to make too much noise, okay? I don't want people to know where we're at, okay?
All right, I'll keep it down.
All right. So are you ready for this?
We don't know until you start talking. We really never know.
All
Go
right.
for it.
So we're on podcast number 402, 402. And the name of today's podcast for flipping houses for rookies is Subject to the Legal Heist Causing Creative Real Estate Rookies to Retire Early. Here's the description. Buckle up, rookies, because we're about to blow the lid off the hottest real estate strategy that's turning average people into overnight millionaires. It's called Subject to, and I'll explain why it's called that in this episode. If you are slaving away at a soul-sucking 9 to 5, you are going to want to join this new breed of real estate rebels using today's explained loopholes to snatch up property left and right without hefty down payments or expensive ways to find these deals. Imagine after today, you could actually start building an easy portfolio that will get you retired years, if not decades, ahead of schedule. Today, we will not be pulling any punches, Peter, and revealing stuff like how to legally snatch houses without risk of going to jail or losing your life savings, how to easily explain sub 2 deals to sellers so they will go with it, bulletproof paperwork that makes these deals ironclad, even from the bank's due on sale clause. So stop spinning your wheels in today's rat race and take control of your financial destiny, which is why you can't afford to miss this episode. So tune in now and let's start your financial freedom. You came back just in time for me to finish.
You know what's happening? It's my camera. I'm getting some flashes on the screen. I think it's my laptop camera and my Logitech. So if it gets weird, I'll unplug it again and just go with my laptop. But I think I got it.
Oh, I find that hard to believe. Something weird happening on your end, Peter?
No, that's not the weird part. The weird part is me being able to fix it.
Well, that was a covert carping comment. Sorry.
Oh, no, that was very obvious.
All right. So let's handle the housekeeping stuff. So obviously we record this podcast every Thursday morning, 9:30 a.m.-ish Eastern Standard Time. When we do, we live stream it on LinkedIn, YouTube, and Facebook. And you can join those live streams on Thursday mornings. Once we do the podcast, it gets processed on Sunday, and it goes on to all the platforms on Monday. If you would like to join us in the podcast, you can come to either LinkedIn, YouTube, or Facebook, and wherever you can find us is Flipping Houses for Rookies. Once you find the live video, you can type in wherever they're allowing you to type book comments or whatever, and I have a screen in front of me and I can answer your questions. However, if it's not pertaining to the podcast, I would prefer you go to flippinghousesforrookies.com. Top right-hand corner, there's a support ticket that will get us get a message to Pete and I directly. Or if you want to join our little mastermind group for free, you can go to WhatsApp Messenger and type in Let's Talk Real Estate. That's a weird group, Peter, because sometimes it's really active and sometimes it's not active. So sometimes it goes days or weeks without anything, and then all of a sudden for days or weeks it blows up. So
but when you have questions, it's there, right?
You can initiate anytime you want.
That's all we need. If we're fine, we're fine. If we're not, call.
So I kind of go with these podcasts. I ebb and flow with them. Sometimes I make them completely for rookies. Sometimes I make them for my coaching clients. Sometimes I make them for creative REI replay students, which is the software that we own that does all the creative REI replay stuff for you, 90% automated. We're the only company on the market that has something like this, and we are definitely growing because people are finding out about it. So, some podcasts are really light and really easy. Some podcasts are pretty heavy. This is not a light podcast. It is, I broke it down as much as I can in case you've never heard of Subject 2, but this is more along the lines of if you already know what Subject 2 is. Although I will explain what it is and you'll get a concept of it. This podcast is more for a little bit more of an advanced person. It's not so much a brand new rookie, but maybe somebody that's been around for a little while.
Mm-hmm.
Okay.
Sure.
So here we go, Peter, in the Big Boys Club.
Okay, doke.
I decided to take a break from the lease option stuff for today because we've been really working on that stuff.
Yep.
Because that's the best way for our listeners, or the fastest, easiest, no risk way to find deals, especially if you're doing the Grand Slam offer. We will probably come back to that because we haven't done anything on that in probably a month or a month and a half. So we're going to come back around to that.
Mm-hmm.
I'm only doing this because in my coaching group, we meaning myself and another coach I work with, we are seeing more and more of these deals showing up, which tells me that the market is changing rapidly. And I'm starting to hear stories again of sellers just wanting to walk away or let the coaching client take over mortgage payments and stay in the house. I mean, stay in the mortgage, stay in the seller's name and give them the house. That's what I'm trying to say.
Mm-hmm.
All right. But now, before I get ahead of myself, let me explain what Subject 2 is.
Okay.
Subject 2 is a slang term. Subject 2. It's called Sub 2 or Subject 2, right? Actually, like I said, it's slang for you're going to take over your seller's mortgage agreements. In other words, when they got the loan, they had a lender.
Right.
So every loan has a lender and a lendee. The seller is the lendee.
Mm-hmm.
The person giving them the money is the lendor. Okay. There was an agreement between the two of them. Okay. What basically happens is, real quickly, I don't have this in my notes, and I don't know if I have time to do this because we got a lot to cover. But basically, what happens, especially with a bank, if you borrow money from a bank, they write a note.
Mm-hmm.
The note is all the terms and all the information about the loan. In other words, how much did they lend? When are the payments due? How long is the duration of the loan? What happens if they default? What happens if the house burns down? What happens if there's eminent domain? You know, all these things. Eminent domain means the city takes over the property, right? All these things, right?
Yeah.
But unfortunately, most buyers don't have a lot of assets, which is why they're borrowing money. And if they don't pay, the note's like toilet paper. I mean, it just gets flushed down the toilet and nothing happens, right?
Mm-hmm.
So we have this thing in our society called a mortgage. And basically, a mortgage is a bridge between, it's a legal bridge between the note and the collateral, which is the house. It connects the two documents together. So if you default on the note, the mortgage is the bridge or the legal path that the lender would have to travel to get the collateral back, which means the lender's money.
Mm-hmm.
Does that make sense?
Yeah. I mean, you lend money to somebody. So, well, if you don't pay me, well, I'll give you my house, or I'll give you something, or hold this. Like, well, you go to a pawn shop, give me money, and you hand over some jewelry. You know, the person needs some safety in giving you money so he doesn't lose.
Right. So what happens is this giving back, see the deeds in the person's name, in the buyer's name. So the lender has to go sue them, and that's called a foreclosure, and it's done with the mortgages. Okay.
Right.
So here's what happens: is the mortgages are what's filed. The mortgage is not the loan. The note is the loan.
Mm.
Okay. So
Yeah.
go ahead.
Yeah. Well, people think the mortgage is the loan.
Yeah. Well,
I
it's
got to
slang.
get a mortgage. You can't get a mortgage without a loan first.
Right. So here's what happens is almost uh, what we're doing is taking over the agreements in that note.
Mm-hmm.
So we're agreeing to abide by the agreements that the seller originally made with the lender. So that means it's subject to those agreements. So we're taking the property over subject to those agreements and anything attached to the title.
Mm-hmm.
So it's not just a loan. Subject to is not just a loan. Most people think it's just a loan. Subject to
Oh.
is the loan and anything else attached to the title.
Well, it makes sense to explain today. Like, why do they call it a note? Why don't you just call it a loan? Well, the note is all the details about the loan and anything connected to it. So there's, all that information. So that makes sense to call it a note, all that written information about the loan.
Right. So I'm writing a webinar right now, which is pretty cool because what I put in there is that well, a subject to is almost like the old assumable loans that were back in the 70s and the 80s.
Mm-hmm.
See, real estate is made to take money out of it, not put money into it. The reason why is if you know how to do things like we're talking about today, then you don't have to go replace the loan. See, banks want you to believe that you have to replace the loan so they can lend more money and get more payments.
Mm-hmm.
That's what they get paid. That's how they make millions, tens of millions, hundreds of millions of dollars. That's the reason why they have the biggest building in every city, right? It's because they make money lending money, right? Which is
Yeah.
a whole other story in itself. But the point is the reason why there are so many rumors and so many people that say you can't assume a loan is because nowadays they put it in their paperwork. They put in the paperwork, in their documents, in this note that you can't assume the loan,
Mm-hmm.
right?
Yeah.
Or they have a due on sale clause. So when you move the deed, you have to pay them up front. But I'm going to cover all that today.
Okay.
Okay.
Mm-hmm.
Yeah. So Sam has a question, but I'm not going to be able to answer that today, Sam. If you want to send a support ticket, because it doesn't have to do with today's podcast. I'm sorry, buddy. He's asking about uh, how is it to understand being involved in an investment such as a real estate property through a partnership? Yeah. Legal semantics, drafting a binding agreement. Yeah, you'll have to do that. You'll have to send me a support ticket, buddy. Okay. Sorry about that. Okay, um, so what happens is if you understand how to take these loans over and not disturb any of that stuff, then you're successful. The lie is that you can't do it
Mm-hmm.
because I've been doing it for 30 years. Right.
Mm-hmm.
So really what happened is these loans, these assumable loans that I was talking about in the 70s and 80s,
Yeah.
were government mortgages, and you could assume the mortgages and not reapply.
Mm-hmm.
But they got abused like everything else, and they stopped doing it.
Mm-hmm.
But if you know how subject to works, you can still do this assumable stuff, which is what we're going to talk about today. Okay.
Sure.
So the first thing to know is real estate deeds, when transferred, most people don't know this, Peter. We forget that we know this, and most don't.
Oh.
And I'm not being arrogant, but it's just I started talking about this recently, and I was surprised at how many people didn't realize this.
Oh, what's that?
So when you transfer a deed, that deed carries with it everything that's attached to it.
Oh, well, it should.
So if I were to buy a property from you,
Mm-hmm.
and let's say you had a bank loan, and you
Mm-hmm.
had a mechanic's lien, and you
Mm-hmm.
had a tax lien on that property, those liens are attached to the deed.
because they're involved with the property itself, like not a personal loan or you owe the IRS money, or it's like directly related to the property.
Okay, so let's back up for a second. We use this property for collateral. What does that mean when we get a loan?
Well, that means if you don't pay the loan, somebody can use the property to get their money back, sell it, do something with it. So they're covered. I wouldn't lend money and just hope the guy pays me back. And if he doesn't, I'm out. I wouldn't do it.
So what I'm saying is there's collateral. In other words, the money is when it's sold. So the reason why there's a mechanic's lien and there's a tax lien there is because that's an encumbrance. I hope I'm saying that right. In other words, it's a barrier for the person selling the property to get that money. The liens have to get paid first.
Yeah.
To clear the title to pass it on to the buyer.
Mm-hmm.
So the liens, the bank note, I just went blank. The bank note and the mechanic's lien and the tax lien, they're put on the deed to cloud the title, meaning that it's not free and clear. Right. So you can't go to the closing and just pay off the bank and not pay off the other two.
Okay. But the money that comes in on the sale goes to pay all that stuff off, and whatever's left winds up in the seller's hands. But that's how he clears his debt, using the equity profit from the house.
So realize anything attached to a deed is looking for money.
Mm-hmm.
So you have to just make sure that when you take a house over subject to, you count all that money as what's owed.
And how do you find all that out so you don't find out later?
We do a title search.
Right. And they go, look, they'll find anything connected there.
I pay between $150 and $200 for a title search. I do that once I get my documents signed.
Mm-hmm. Okay. Better safe.
Yeah. Okay, so this is the important thing. So in other words, I am as an owner of a piece of real estate with the deed in my name or my entity's name, I can pass that to anyone else with all those encumbrances, all those things attached to it.
Mm-hmm.
It's not like a car. With a car, you have to pay off the lien before you can pass the title. With a house, you can just pass it with all that stuff.
Mm-hmm. That's right. When you buy a car, if you have a loan on it, you don't get the title till it's all paid off.
Right.
Yeah.
Okay, so that's important to know.
Mm-hmm.
Okay, so the second thing, which I've already
we have another message coming in from one of our listeners.
I don't understand what Sam is saying.
How easy is it to yell at a TV? Okay. Non-question. Bye, Sam.
I don't know what he's talking about. Okay, so the second thing to know, and I alluded to this a few minutes ago, banks make millions, tens of millions, and hundreds of millions of dollars in interest fees. So they want you to believe you need to get a new loan in real estate, which is crazy to me. Why would I want to get a new loan for a property when the seller already has the money needed to own the property there? Fact is, over here at Creative Real Estate, the creative real estate industry, we're professionals at controlling or mastering using the paperwork that controls the property to do deals. See, this is the big lie. The big lie, the biggest lie in real estate, the biggest myth in real estate, that once you pop through that little, it's like a balloon, right? It's got a very thin skin.
Yeah.
Like, so once you pierce it, it just pops. It goes away. Right?
Yeah. Well, that's probably one of those things that people hear it and they don't question it. But I mean, the first thing you should do is anytime somebody says, no, you can't, they can't do that, just go look. Maybe there's a way to do it. Just because somebody says there isn't. I mean, we live in a world where, We couldn't fly. We couldn't do this. We couldn't do that. There was no electricity. You couldn't. And look at all the stuff we can do. So just maybe there is a way.
See, the lie is that money controls the real estate.
Oh, it's not the money. It's the
money buys the documents,
and
the documents control the real estate. But who says that you need money? See, the bank wants to lend their money, so they make you believe that you have to have money to buy those documents or get those documents created so you can control the property.
Yeah.
Is this making sense?
Sure.
Just like I just explained to you before, the lender writes the note, right? And this note is actually toilet paper if the seller defaults, right? All this is still true. So what the lender does is use this thing called the mortgage, which we talked about, which hooks the note and the collateral together. So when the buyer doesn't pay, the legal document that the lender can use in court to get the deed is the foreclosure. Okay.
Sure.
So the trick is, don't break the collateral.
Right. That would make them very nervous if they thought, geez, if they don't pay, we can't get the money back. So as long as you don't do something you don't go to the bank and say, hey, I'm assuming the loan from this guy. Thank you very much.
Right.
You don't do that. I was thinking, well, what's the difference? If you sell the house, the guy pays the mortgage off, pays the note and loan off, and you get another one. So they still only have one mortgage either way. But the mortgage that we're taking over has been paid down a certain amount. So there's less of it there. Maybe the rate's lower. So it is advantageous to us and maybe not that advantageous to the bank. But you know what? The bank don't need no more money. They got plenty.
Right.
Let us have some.
Right. So we're going to go one more layer deeper. I hope I'm okay. We're okay. We're okay right now, right? I'm not confused or anything. We're good.
I'm following. Okay.
Okay, good. So what's the difference between a deed and a title?
Well, the way you said something just a few minutes ago, the deed, you can get a deed to the property before you pay the whole thing off, because you get that. You get the loan, but you get the deed. The title, like title to your car, you don't get that until you pay the car loan off.
Right.
Maybe the difference is you can drive away in the car and disappear. You can't drive the house away, so it's not risky. It's there. You have an address, you can find it.
Right.
Can't hide it.
Let's take Michael Gerber's book, The E-Myth, which is the entrepreneur's myth. Right?
That's an older one, right? That's from a few years back.
Yeah. So Art Gill says, good morning, Bill and Pete. Great topic. I'm having trouble explaining to people how they can still buy another home if they agree to the lease option. So I'm going to cover all that before we leave here, Art. Don't leave, because I got that coming, baby. It's coming. Matter of fact, it's coming in a few minutes.
Oh, okie doke.
Because I've done this a lot. Exactly what you're talking about.
I even know the answer to that. But I'm going to wait for the right time. Go.
Yeah, you should know. We've done some.
Sure.
Michael Gerber put an E-Myth, which is the entrepreneurial myth. He talks about building systems in a business. But the reason why I bring him up is because he labels there's an owner, there's a manager, and there's an employee. Okay, in every business. Okay, now there's different branches of that, but that's the core of the business. That's what makes up a business.
Even if you're one person, you own it, you manage it, and you work the thing. Now, as you expand, you can wind up with 3 people and split things up. But those 3 things have to happen.
Right.
Okay.
So would you say that the owner has different jobs than the manager?
Yeah. He's looking
Would
at
you
different
say
stuff.
would you say the manager has different jobs than the employee?
Certainly.
Okay, so each title has its own responsibilities and its own action, and
Yeah.
for that case, its own beingness, like who they are,
Mm-hmm.
how they would think and position themselves, right?
Sure.
Those are titles.
Mm-hmm.
There's an owner title and it has certain responsibilities. There's a manager title and it has certain responsibilities. And there's an employee title and it has certain responsibilities.
Yeah.
In real estate, when you say you have title, that means that you are officially naming yourself in charge of this property.
Mm-hmm.
So that means you are making or not making the different decisions for this property. So if it has liens on it, that means you made decisions to not pay your bills and it got liened.
Mm-hmm.
Okay. The
Yep.
reason why they say doing a title search is because they're going through the records to see, based on the activity of each owner, the decisions they made that had ramifications that got attached to the deed.
Mm-hmm.
So the deed is the proclamation or the written word saying, hey, this guy over here owns his property and he's the one making all the decisions. You with me?
Right. What helped me once when you explain title is when you sign something, that's your title. Like you put your name on it. So when I think of title, I think of the name on the deed.
Okay, so
Title. You
now
look
let's
at it
come.
and you go,
I'm gonna move
right.
ahead and then come back in a minute, okay? Because you're gonna understand this in about 2 seconds.
Yeah.
Okay. So there's something very important you need to understand in subject two. And I don't teach this only the only time I've ever talked about this is behind a paid portal.
Mm-hmm.
Okay, because I feel like it's crucial to know. Okay. Here's
Yeah.
what you should know. There's only four types of entities. Four types of entities that can own real estate in America.
Mm-hmm.
The first one is a person.
Yep.
The second one is an LLC or a corporation, and there's variants of those,
Yeah.
right? There's a partnership,
Mm-hmm.
and then there's a trust. Each one of these is a title. So a person, so Peter Coca-Cola is title of this property, and the deed reflects that Peter Coca-Cola has title to this property during this time.
Mm-hmm.
AKA Peter Coca-Cola is the one making decisions for this property. So if I want to do anything with this property, I have to go back to Peter Coca-Cola because he has title of ownership.
Mm-hmm.
An LLC or a corporation has the same thing. Even though they're masked,
Mm.
there's still one person or two people that make the decisions,
Yep.
right? They're just masking, trying to mask their name for legal reasons and protection. A partnership is the same way. A partnership is a different type of an LLC that's written a specific way, saying that not only do these two or three people, or however many, two or three people own this property, but they have different levels of ownership by percentages 50%, 30%, 80%, 16%, whatever the numbers are.
Right.
So there's different levels of responsibility.
Mm-hmm.
And then a trust is a trust. That's it. So does that make sense? So when you're signing,
Yeah.
which Sam has, I'm surprised the stream isn't being. I don't know what Sam is talking about. So Sam, some states allow electronic signatures, some states don't. So you have to figure out what state you're in. My attorney says that Connecticut doesn't allow them, but we use them all the time, and I haven't had problems. So there you go. All right, I'm going to tell you very short order, the way AI and everything's going, that we probably won't use Light Ink anymore. All right, so I'm sorry for getting all technical, so bear with me because this is very important. Very important to understand these four entities and who has title.
Mm-hmm.
Okay, because you can look through the documents and figure things out if you understand this basic concept: who has title and who's on deed.
Mm-hmm.
Because Bill Hawthorne might have title, right? But on deed it says Connecticut Homes or Us is the owner.
Okay, that got confusing. Okay.
So Connecticut Homes or Us owns the title, owns so the LLC owns the property,
Mm-hmm.
but Bill Hawthorne owns the LLC.
Oh, okay. I was trying to think what piece of paper has that name. So like in L, I was almost gonna ask like the first example when you use my name because I'm a person owning the property.
Right.
This next three are like entities, an LLC, partnership, the LLC, or the trust. And they usually have like names, not a person's name, but trust, like maybe the address, something like that.
Right.
And then there's a name afterwards.
Right.
Okay.
At the
So
end of
the
the day, there's
entity.
always a person or two or three or whatever that own it. Usually not more than that. Sometimes there is with REITs and stuff, but that's
Yeah.
a different game, right? But
Okay.
the houses we're dealing with usually have, a couple names and when you follow your nose, follow the scent, you're going
Mm-hmm.
to get back behind all of these entities and find the person making a decision because the house can't make a decision. Right? I've never been to a closing and the
Mm-hmm.
house signed the documents.
Mm-hmm.
It's always a person or two or three.
Yeah.
Right. Now, does all that make sense?
Right. So those entities are not names. They have like a business kind of a name,
Right.
blah, blah, blah. And then there's an actual name after that.
Right.
Okay. That clears it up for me.
So the deed will proclaim the entity, but then when you chase down the entity will give you the name of the person that's actually on title.
Right.
Okay.
Okay.
Now, when you take over a seller loan, it's very important we do these two things. And I'm talking subject to. Right?
Mm-hmm.
So the first thing is you don't break the collateral bridge that will make the lender nervous.
Right.
Right? As long as they're comfortable that the collateral is safe and they can legally get it when a default occurs, right?
Mm-hmm.
Then you're good. They would rather have current payments so they can make their millions and millions.
Right. They want to keep collecting. Anybody who's ever worked for a bank or knows somebody, they want loans, interest, payments, fees.
Which is why when you hear people talk about subject to, they're like, well, I never heard of anybody, or it's very rare, and that's the reason why. Now, if you stop paying, if you take over somebody's mortgage and you stop paying, then you're going to find all this out.
Yeah, yeah. They'll come a looking, right?
Right.
Mm-hmm. They'll be looking, who's gonna pay me on this loan?
Right. So the second thing is we take the property, and this is important. So the first thing is we don't break the collateral.
Mm-hmm.
The second thing is how we're going to do that actually is we don't take the property, we don't
We don't take the deed out of the guy's name.
hang on a second. Let me just read this.
Mm-hmm.
Okay. So we take the property out of the person's name,
Mm-hmm.
which is an entity number one. Remember, there's
Right. The person,
person's
individual. Yes.
the person's name. Then there's the second one is an LLC, a corporation. Third one is a partnership. Right. We take it out of any one of those, which one it is. It's usually a person's name, and we put it into a trust.
Okay.
By the way, we do this with a 2-page document without any legal assistance, and it's super easy if you have the right documents.
Mm-hmm.
Right? The document's called a warranty deed of trust. It's written a very specific way. And behind it, there's a declaration of trust. So the warranty deed of trust is the deed that goes on file that names the trustee, the name of the trust and the trustee. And the declaration of trust is all the rules of the trust that does not get filed. So nobody knows who the beneficiary is. It's hidden.
So the
'Cause it's
trust,
not on record.
the trust has a name of the trust, but it bears as title the original seller's name is there.
Say that again.
The first one, the warranty deed of trust, has a name of the trust, but it has the seller's name as the on that particular deed. And the next
So
declaration,
the seller is transferring the deed or the ownership from the seller to the trust.
right?
And the trustee is the only one that can sign documents in a trust.
Mm-hmm.
I mean, that's the reason for a trust, because if I was your son and you were my father and you passed away and we had a trust, the reason why you're giving me a trust is because you're dead and can't sign the documents and I can keep things going. So
Yeah.
I'm the person that's going to sign all the documents and do everything.
Mm-hmm.
You're trusting me, aka the trust. We're going to go over that in a minute, right?
Mm-hmm.
So if you're looking for these documents, there's 2 links in the description. There's one if you want to do it manually, and there's one if you want to automate it. Okay, so there's 2 links in the description if you want to go get these documents.
Wow, that's a nice bonus.
Yeah. Okay, so does that make sense?
Mm-hmm.
All right. So let me get my thought here, because there was something else I wanted to add to that. So we're going to take, oh, I know what it was. We're going to take the person's name off the deed and we're going to put it in the trust. Now, I think I cover this later, so I'm going to do a little bit sooner. But just to be clear, because it would make sense, I would say it now. We're not, the first thing you're going to run into is finding somebody that knows the right definition of a trust, because there are about a half a dozen different types of trusts. We are using a property trust. What that means is the only thing in the trust is the property that's named on the trust declaration.
Well, that's important because it's not all the other stuff a seller might own.
Right.
That would make it extremely complicated. So they call it a property trust.
Right. So if you were to go to an attorney, I'll guarantee you can go to 10 attorneys and 9 3/4 of them don't know what that is.
Wow, really?
Yeah.
And they start doing a state trust or some other kind of trust?
Family trust, if they start asking for social security numbers, it costs $1,500, it costs $15,000. There's all different kinds of trusts. Okay, you don't need to do that. They don't understand, and I know because I've coached a lot of people. I've done this myself. You don't need an attorney. What you need are these documents, these 2 documents: the warranty deed of trust and the declaration. You can give those to your attorney or their closing agent, and they can follow them. But until they see those, they really don't know what it is. And if you do have an attorney that does know what they are, it's because they're doing subject to deals and they've done that research, which is very rare. It's becoming more and more nowadays, but that's important, right? So let's just leave it at that.
Okay.
Okay. So once you take the entity from the person's name and put it into the property trust, here's what happens once you do this. Okay. The bank, number one, the bank, and there's actually, I'm going to give you 6 things that happens automatically. Number one, the bank assumes you're doing estate planning and never worries about having broken the collateral bridge. So it's a soft way of saying we switched the entity from the person's name into a trust. And what I do is when I communicate to the bank, right, is I tell them from now on, I will be paying so-and-so's mortgage. I'm the trustee of the trust, and they know that I'm in charge of all that. So they will not argue with it.
Because people do this without besides selling a house. So you can just go put your property in a trust.
Yep.
Forget selling it. You're just doing that for estate planning. So that's not unusual to them. It doesn't bother them. I've done it for you several times as a trustee. Now, the first time I was nervous, like, what if they? They go, well, thank you very much. Send me this document. What's your name? Okay, thank you very much. It's a secretary working at a desk. She doesn't care. She's not worried about loans and
Which brings
things.
up a point. I didn't put it here. I'm gonna tell it to you now because you're bringing it up.
Yeah.
Trustees are transparent.
Mm-hmm.
In other words, there are no legal ramifications. They can't get sued. They can't. They could be named on a lawsuit, but they won't get sued. Looking for documentation. But I've never seen that happen or heard that happen. So it could happen, but I doubt it. And the other thing is the tax, all the money made, the tax is transparent, and the IRS does not go after the trustee; they go after the beneficiary.
Well, it's like the trustee is kind of a manager in that 3-step that you're talking about in the E-Myth. He's more like just the manager guy. I didn't do. He's not the owner. He's not responsible. He's kind of working and taking care of things.
That's right.
Okay, that makes sense.
Because we do this, you could do these closings at a closing agent or with an attorney.
Mm-hmm.
Because of the way we do this, because you have a regular closing and there's no just a regular real estate attorney could do these, especially if they have the documents that are in the description. Yep. I would not go to an attorney and have him draft these documents. You will not get a good closing. But if you have the documents and say, here's what I want to do, they will follow along. When you do this with an attorney, which is number 3, when you do this with an attorney or a closing agent, there's a settlement statement.
Mm-hmm.
Now, we've gone over this on other podcasts. If you go into Google or any search engine you're using, nowadays could be OpenAI, and you ask for a real estate closing settlement statement, or its nickname is a HUD-1.
Mm-hmm.
See, most people don't realize it, but every real estate transaction in America nowadays is put through the government, and there are standards that have to be met before you can actually close, one of which is a 3-day cool down period. So the documents are produced by the government. So the closing agent is using the government's documents. So if you go find a HUD-1 or a real estate closing statement, I think it's line 503 on the seller side and line 203 on the buyer side, but it depends. I haven't looked at one in a while. Yeah. But it says taking over the property subject to.
I've seen it. I pulled out some of my old ones when you said that. It's right there on the statement.
So it is very legal. It is not illegal like most internet hacks talk about. If they're saying it's illegal, they just don't understand that strategy, and I would not take their advice.
It's on the government statement. And that's housing and urban development, right? The HUD?
HUD, yeah.
Okay. I mean, that sounds like government, housing, urban development. Sounds official.
All right, number 4. Now, the seller can present these closing docs, aka the settlement agreement or the HUD, once they've closed, to their new lender and get a new loan.
Oh.
Because the new bank will recognize it as closed.
Oh.
Now, the biggest problem that I have with people is they have a one-sided calculator. They're like, if my mortgage payment is $1,800 a month, and that's when I go get a new loan, it's going to show up on my bank statement or my profit and loss statement as an additional $1,800, and my income isn't high enough to cover that $1,800 plus my new mortgage.
Do they forget that they're taking in money on rent?
So that's what the problem is if I'm paying the $1,800, they can put that $1,800 as income and then the $1,800 as a debit, and it balances out. And if you do, and the bank will do this automatically, if they do that and they see the settlement statement that they no longer have legal ramifications to it and somebody else is paying, it's like a glorified lease option, right? Then they can go get another loan. I've done this many a times.
Yeah.
Now, If you don't close with a closing agent and get a settlement statement, which I don't recommend if you're new, what I've done in the past is I've just written lease options for the term of the loan.
Mm-hmm.
So I would write, I'm paying $1,800 a month for a lease, and the option agreement is the length of the loan.
Mm.
And I give that to the bank, and that will satisfy the bank. Because the bank wants to see that they have the income and that the income is legal.
Okay, so even though it's a subject to, a person still is leasing the property in the interim. So it actually still is, there's paperwork to show that.
Yeah.
Oh, that makes sense too.
So
Somebody's paying it.
you can back up the income. Now
Hmm.
I write a lease. What you just said is different than what I said. I write a lease, right?
Mm-hmm.
I write a lease. If they're going to get a loan, I write a lease that matches the mortgage commitment.
Okay.
So if it's 22 years left, I'm writing a lease for $1,800 a month for 22 years on the option.
Oh, that's cool. I haven't heard you say that. Well, that makes sense. That's what's left on the mortgage,
Because that's what I'm committing
on the
to.
loan. Yeah. And then it's paid, so it's over.
And they give that to that's if I don't close with a closing agent.
Oh, okay.
If I close with a closing agent, then I get a settlement statement, and I just show them the settlement statement. I give the seller the settlement statement because they were there and signed it, and they give that to the new loan agent, and it goes away.
And when the person buys the house, the new buyer, in less than 22 years, it's fine. It gets paid off, so they don't care.
Right.
I don't care.
Number 5, if the seller wants money for his or her equity, let's say 20 grand, and our numbers support that, you can have a closing agent or an attorney, whoever they are, a closing agent write a second mortgage for the 20 grand. Now, I for a very long time would write a mortgage. Let's say I'm buying a house, it's worth 200, and the mortgage is 120, and they want 140. So I would take over the 120 mortgage, and I would write them a note for 20 grand.
Yeah.
So the first thing that happens is that I don't like is that I have to have a balloon at the end of a mortgage.
Yeah.
At the second mortgage.
Mm-hmm.
Okay, so a lot of times what happens is, well, I'm not, I'll get it. So here's what happens. I would offer my seller the deal at $20,000, the mortgage, the second mortgage at $20,000, no interest, no payments.
Okay.
But that means I have to pay them the 20 grand within 5 years or 10 years.
Right.
So I'm banking on my buyer cashing me out, which nowadays I don't do anymore because they're getting less. I'd rather have the cash flow.
Wow.
Okay. So what I've been doing recently is I'll extend the loan, the 20-year loan, the length of the mortgage, and then divide it with no interest into those months. So if they got 22 years left on the mortgage, then I will give them 22 years on the note.
Okay.
Now, the reason why I did it before, I'm diverting because we're running out of time here. So the reason why I did it before is I did no interest, no payments, we'll say for 5 years, is because what I used to do is I would go back at 4 years and say, hey, I just got a bunch of money, that $20,000, would you be willing to take 5 grand for it?
Yeah.
And 85 or 90% of the time they would say yes. But I don't do that. I'm not. I don't need to do that anymore. I'd rather just write the term of the $20,000 over the course of the 22 years and pay it each month because property always appreciates, the value goes up, so I'm not worried about that. It might be a little bit tight right now for my cash flow, but it will work its way out.
Because you're actually making a payment on that, but stretching it 22 years, so it's not that much.
Low payment, yeah. Or as much as I can get.
Yeah. No.
So
Again,
22, no. If 22 years, let's see here.
Well, call it 20. Call it 20 years. $20,000. $1,000 a year. It's less than $100 a month. And it could be tight the first year or two, but then lease lease amounts go up, payments go up.
So it's 264 months. That means I'd be paying him $75 a month.
Yeah, no big deal.
Right? Or you can bring that down. If you can afford to pay 150, then you can do it in 10 years.
Yeah.
Okay. Number 6, you don't need new money from the lender for this or any other property. You have a loan on this property for the extent of what the seller originally agreed to. So that brings us to the question, how many properties can you own with little bit down, no bank qualifying, credit reports, no credit reports, no ceilings of loan to value ratios or loan to debt or debt to income ratios? It all goes away.
Credit scores, all that.
As soon as you do this deal, you become the bank and you become the guy with the gold or the girl with the gold, and you make the rules. Now watch this. It's very simple. So lean in and listen now. Very simple. Here's how you explain to the seller without giving a seminar all the technobabble. Are you ready?
Absolutely. This is important because you can't do this if you don't know what to say. Go. This is good.
Art, I hope you're still here because here we go.
Here, this is good.
You tell the seller you're going to take over the property and have a closing with a closing agent. And you're going to put the house into a trust and then manage that trust. That's all you got to tell them. Is the loan going to stay in my name? Yeah, the loan's going to stay in your name, but the trust is going to manage it.
And the deed?
Actually, the deed is going to go into the trust. You're going to deed the trust.
Yeah. Okay.
You're going to deed the house from your name to the trust. We're going to open a trust, and the deed's going to be in that trust. The loan's going to be in that trust. And we're going to manage that trust.
That sounds better having the deed in the trust than the deed in your going to you personally.
Right.
Like, I'm going to have your deed. No, you can't have my deed. It's my deed. But in the trust sounds much better because it's like this third entity on the side there, not you.
Well, listen to what I'm telling you because you missed the most important part. So I'm going to repeat it.
Go ahead.
You tell the seller you're going to use a closing agent.
Right. That makes them comfortable right there.
To put the house in a property trust. Then we are going to manage that property trust. And they get to just walk away and never have to worry about it again. And you tell them the loan is going to be managed by the trust. Also, when you do this, you could just take all of my tested and proven documents that are in the chat. And I'm not trying to sell you documents. It's just I'm trying to prevent all the support tickets of how do I get those documents?
Yeah.
Right? Give them to your closing agent. And all you need to do, if you use a closing agent, this is only if you use a closing agent, which is usually between $2,000 and $3,000, depending on what state you're in to do a closing. Because when I do them, I don't do this. I close them myself. It costs me $70 for the paperwork to be in the city of Meriden where I do these. I pay $70 to have the paperwork filed at the clerk's office.
Yeah.
So it cost me $70.
But
if you're new, you can use a closing agent. Hang on one second, Peter. If you're new, you can use a closing agent. And here's what you do if you use a closing agent. All you need to do is write a purchase and sales agreement saying it's a subject to deal and give it to your closing agent with all the other documents that I just spoke about, and it will go smooth. They will do all the documents. You don't need to worry about it. You'll pay for it. Like I said, it's probably $2,000 or $3,000 to do that. But where are you going to go and buy a property? No bank qualifying, no down payment, no fees, no nothing other than just the closing of a couple $1,000. Where are you going to do that?
Why is it more than a usual $500-800 fee for a lawyer? Why is it that much?
Because escrow companies charge different money. When I do a closing in Ohio with escrow company, it's between $200 and $2,500.
Oh, no kidding.
Yeah.
Oh.
And Connecticut is different.
Wow. What I was going to say was, I think people believe that you need permission to do things like this. Like a lawyer has to give you permission, the government has to give it. You don't. This is between you and the seller. They give you the permission when they sign those documents, right?
Right.
You don't really need anybody's permission. I mean, why do we need permission to live and to do things? You know, if it's written and it's signed, one can always go to a judge and say, look, this didn't happen, that didn't happen. But the owner gives permission. It's his property.
Right.
Good.
So Art, I don't know if you're still there, but could you, oh, there he is. Okay. Still here. Good. So did that help you, Art? I want to make sure, I mean, I'm going to kind of move on a little bit so you can type in there, but I want to make sure you fully understand that it's a very simple, they accept it very easily. You know, you're going to use a closing agent. Nobody, I mean, you can't manipulate the closing agent for dishonesty. I mean, I guess you could. There's a lot of things that happen in this world these days, but that's what they have to do. Right? Now, I also put in so if you wanted to do this yourself, I also put a link in there. I put a link in there that we have a tool that will automate all the documents. So once you put in the seller's name, address, and that basic information, it pre-populates all the documents for you. So he says, yes, great, simple. Their main concern is that their bank will release the lien. So the bank will not release the lien until you pay it off. So if you have someone that's saying that I don't want to do subject to because I want them to release the lien, that means that they are concerned about giving you a deed and you stealing the property and they get stuck with the lien. Mm-hmm. So one of two things there, you're not doing a good job of explaining it and they don't trust you, which is common. So what I suggest you do is you first do what we just said. Try this on a couple deals. Tell them you're going to put it in a trust and we're going to manage the trust. And the trust is going to make the mortgage payments. Try that first. If the seller's still pushing you on taking the lien out of their name, then what you could do is just do an agreement for deed or a land contract. They're the same thing. And don't have them relinquish the deed and keep them in control. Mm-hmm. You can still do a subject to deal. Right? Okay. Now, next thing, most people don't understand that these trusts okay, Art's good. Most people don't understand that these trusts or people that don't understand how to do this. I paid thousands of dollars for these documents, thousands of dollars for these documents, and I think I paid $3,500 for the first set of documents, and then I kept buying more documents after that. And recently, I mean, I don't even know. I probably got 10 grand in these documents, but I don't know. I've never added it up. Right? It's not the amount of money I have into them; it's the amount of. I've been to court with them a couple times, so I know they're good. And I've used them and my coaching clients use them and I've never had a problem with closing agents or anything like that, right? So just realize if you use the wrong documents, that can trigger the due on sale clause. And most often, you'll do the deal unsafe, right? Because they confuse a property trust, like I said before, with like some other variation of a trust. Oh, so they're not doing them right. So realize a trust is so when, like I said earlier, an actual trust is designed so that when the beneficiary is incapacitated or dead and can't sign their normal affairs documents or anything like that, then the trustee can do that.
Mm-hmm.
Right? Okay. So I wanted to say that at this particular point, we're at an hour. Technically, the podcast is over. So you've gotten enough information. So if you wanted to skedaddle, then I understand you can go off. But I'm going to go a little bit longer today. I know normally we go to 5 or 7 minutes, but I'm going to go a little bit longer today just for the advanced guys. And if you want to stay, then I'd be happy to have you. But I'm going to go into another level, which is just a little bit longer, maybe 10 or 15 more minutes. Okay.
Mm-hmm.
Is that all right, Peter?
Sure.
Yeah. So when you close with an agent, what you're doing is you're taking the property from the seller's name and putting it into a trust. So the closing agent, when it's done this way, will file your deed, which is a deed, deed of a
warranty deed?
Yeah, warranty deed of trust, right?
Mm-hmm.
Which means that you're warrantying that you know what the encumbrances are, or you're taking them on, right? Or they're not there. And you're also putting it into a trust, and you're transferring ownership. So it does three things.
Mm-hmm.
So you'll have the seller be the beneficiary, and you would be, or someone that represents you would be the trustee.
Mm-hmm.
Done this way, as soon as the deed of trust is filed, you can actually wholesale this strategy to someone else.
Huh.
And nobody has ever talked about this.
Hmm.
Not that I've seen anyways. Okay. The way you do that is at the closing, which you should be at, the first couple. At the closing, what you can do is you can actually have, which is before the deed is filed, you have the seller sign an assignment of beneficial interest. So if you were wholesaling this subject to deal, you would have an agent close, take it out of the seller's name, put it into the property trust, do the entire closing with you as the trustee.
And the seller is still the beneficiary because it's his house.
Seller is the beneficiary.
At this point.
And then before you leave, there's literally a 3-paragraph or 2-paragraph document saying that they are assigning their beneficial interest to, and that could be your wholesaler. Okay. Just make sure you tell the seller from the beginning up front that you'll either be closing the property in your name in the trust or one of your partners. And of course, your partner is the wholesaler paying a fee for the paperwork. Now, why do I bring this up, Peter? Because this is crucial. This is the best part of the podcast. Because I'm going to talk about something that I know I have never heard. I've looked for this on YouTube. I've been all over Pace's website. I've been all over these guys, Ron LeGrand, all over them looking for this. And they never talk about this. Suppose your subject to seller is behind on mortgage payments.
Yeah.
Let's say 15 grand.
Sure, that happens.
Let's say that the 15 grand is caused because if you go borrow that money with a private lender and pay 9%, all of a sudden your cash flow is not that good.
Right.
It kills the subject to deal, right?
Makes it harder.
So we suggest, which nobody else talks about, we strongly suggest that you buy subject to deals at 80 cents on the dollar. In other words, 20% worth of equity. Because most markets, when they go up or down, don't go more than 20%. There are some, Vegas and Florida are known to do that. But for the most part, markets only swing about 20%. So if you are worried about getting stuck with a property, which you should never worry about, because if you hold it long enough, you never get stuck. But if you're worried about getting stuck with a piece of property, as long as you stay within that 20% band, in other words, don't pay more than 80% of its value, right, including the repairs you have to do, right, then you won't get stuck with the property. So in this particular case, if you got to put up 15 grand and you're over that 80%, or that 15 grand will still keep you in the 80%, but your cash flow is not that good, but you've got a lot of equity still, because their equity is low, but your cash flow is not good because you got to pay the 9% to the lender that's going to give you the 15 grand. Here's how you handle it. You go to your wholesaler and tell them you want 20 grand for this deal. And 15 grand goes to the past payments, and 5 grand goes to you for wholesale notes. And you will find somebody that will put down 20 grand, especially on a $400,000 or $500,000 house.
Right, because he's probably just paying, not borrowing. Because he just did a house deal. He's got money. He's got money sitting. People have money.
Well, here's the thing: most investment loans are 20 to 25% for down payment, which means the most he could buy for his 20 or 25% is a $100,000 house. Right. And he has to go qualify based on his financial statements and his credit to buy that property. What you're saying to him now is, I got this $400,000 house. Give me 20% down.
Or 20,000.
20,000, yeah, $20,000 down, and I'll give you this loan, and it's already done, and it's already been filed, it's already ready to go, and I'm going to sell you the beneficial interest of this subject to deal, and you could take it over, and the owner is aware of it because I told her that I had a partner, and I'm going to tell her your name.
And that's a good return on his $20,000.
Maybe you ask 30,000.
Well, yeah. Well, you ask him, what's the most you could put down?
Doesn't matter the numbers. I'm just giving you the example so you know what happens.
Yeah.
Right? Because you're not making enough cash flow and the deal's kind of on the fence. But for a guy, let's say it's a doctor or a lawyer, a lot of those guys want to buy real estate because they know that their practice, once they stop their practice, the money stops. So they're trying to build a portfolio.
Yeah.
Right.
And they're not going to do creative real estate. They're not going to bother to learn it, make phone calls.
All you need to do is tap into
money.
All you need to do is tap into a couple of these guys, like a doctor or a dentist or a chiropractor or any of these professionals. A contractor would be willing to do this.
Engineer.
Yeah. Any one of these type of people, you just need a couple of those and you could supply them with these deals all day long and make a fortune.
Yep. And if you don't wholesale it, that little couple paragraphs that you had the seller sign, if we keep the property, we're the beneficial interest at this point. We just put our name there.
Number 2, which I'm going to talk about. So if we decide we're going to keep the property, then we're the beneficial interest and we would find somebody else to be our trustee. I'm going to come back to that in a second because this is a big question again. I'm going to come back to the trustee in a minute. But the beneficial interest could be you or your entity.
Oh. Yeah, I guess so.
So
because the trust, the property's in the trust.
Yeah. So me, the beneficial interest is Homes or Us.
Yeah.
And then, so that means that if somebody's trying to penetrate who owns the property, they have to penetrate, aka a lawyer. They have to penetrate the trust first to find out that Homes or Us owns it, and then they have to penetrate the LLC, Homes or Us, to find out that it's me. And in my particular case, the LLC is owned by the family trust. Right. So my which I haven't finished doing yet, but the family trust owns all the shares of the LLCs. So when I pass on, there's a book that I wrote when I die, written by Bill Hawthorne.
No kidding.
For my family on where all my properties are, where all the bank accounts are, and who to go talk to, where the lawyer is, and how to keep the business going so they can keep getting the money.
That's cool. So the family trust is over encompassing with any of the little property trusts underneath it, which the property trust could change over time, but the family trust would own them as they would come and go and shift around.
Here's the problem with a guy like me and you. You can't write a will.
Oh.
You have to write a will every 30 days.
Right,
Because we buy and sell properties. So the properties change. You could change even if I only sold one property or bought one property a year, I still have to change the will.
Yeah.
So the way to do that is to keep the entity Homes or Us LLC, Connecticut Homes or Us LLC. You can keep that entity running, right? Or others. I have others too.
Yeah.
Actually, we're not using the Connecticut Homes or Us as much. We're using other entities now because I keep talking about that publicly, and who knows what's going to happen. But the point is that you keep that LLC running, and it holds the properties, and then the family trust owns the shares of the properties. So that means every day the properties can change, and it doesn't affect the trust or the will.
That's cool.
Okay.
Which explains why I had trouble trying to make a will a year ago with my lawyer and try to see about the family type and the other type. So, okay, that explains a few things. She was having trouble figuring out what I needed.
Right.
Okay.
Okay, so moving on, because like I said, I'm sorry I'm making this podcast so long, but I think I was going to make it 2 podcasts, but I just decided to make it longer today. So here's an interesting thing about trusts. If somebody didn't know you or I mean, obviously we do YouTube videos together, so there's a lot of people that know you and I. But if we were in a regular lifestyle, not teaching and doing all these public videos and everything, what would be the likelihood that they would connect the two of us?
Slim pickings.
So unless somebody knew that you and I were friends or that you and I were doing real estate together, they would not think of going to you as the trustee, or if they find you on title as a trustee, they would not know to go look for me as the beneficiary because they don't even probably know we're friends. So the trustees should not be a family member or somebody that's obvious, like your wife or your children or your cousin or something like that. It should be somebody like what you and I have. So the reason why you do this is because if a lawyer is trying to penetrate the trust, unless they're on the inside track, which is possible for them to do, they wouldn't know who to go look for in the trust. Now, of course, a good lawyer could subpoena the trustee to give them the beneficiary documents, but that's a lot of work, and you can kind of skate around that, especially if the LLC is the beneficiary. The point that I'm trying to make up here, or the point that I'm trying to make here is that these deals are pretty much free from getting liens and lawsuits because you don't know where to lien it. And I think it's against the law to lien a trust. I don't know that for sure 100% in every state, but I know that it's hard to lien a trust. So it's very safe.
Yeah.
Okay. All right. The last point that I want to make is too many are worried about getting stuck with bad deals or deals they don't want later. Right? Or they get in and realize they don't like creative real estate, or they only bought one deal and it's annoying. I'm going to tell you right now, if you're managing property and you got 1 or 2, it is annoying. Until you get multiple properties where you could just have people on the hook, plumbers and electricians and that kind of stuff, where you could just make phone calls, it could be annoying. You're on vacation and somebody calls you and says, "Oh, there's water in the basement."
Yeah.
Wait till I come back in a week and they won't want to hear that.
Sure.
Right? So until you get multiple properties, which a lot of people don't do, you could be one of those people that got 1 or 2 properties, subject to, and you're done. It's annoying to you. Right? So most people think that subject to is hard to exit. I just showed you one way to do it with the beneficial interest, right? You understand?
Oh, yeah.
So if you wanted to exit quickly, suppose you got in this deal and you were in it for a year and you decided you don't want it anymore. Do you have to go sell it? Suppose the market crashed.
Yeah.
You can't sell it. Suppose the interest rate goes from 4% to 8%. Oh, that's today.
Yeah. The balloon.
Right? you can't sell it. Well, the first thing you could do is like what we just said, is you could just sell off the beneficial interest and get a fee for doing that. So you're never stuck with the property, right? The second thing you could do, like I've done so many times, and this is a hidden profit center, right? And you don't even have to want to get rid of the property to do this. This should just be a strategy you put in the back of your mind. What brought this about is in Texas, lease options are only good for 6 months. So this is where the strategy originated in my mind.
Okay.
So in Texas, what we tell people is when you sell, you can sell on a 6-month lease option and then convert them to a land contract or an agreement for deed. They're the same thing. I suggest people do this in Texas because you can get more money. So you can get money for the lease option when they come in and they move in, you get some money. And then you tell them, well, in 6 months, I need more money and I'll do owner financing with you. However, you could do this in any other state. You could put them on a lease option, right? And you could get them to, we'll say 20% for a down payment. So they can give you some money down, like 5 or 8 or 10% now, and then put them on a down payment assistance program.
Yep.
Which means they would pay monthly above and beyond the rent. You don't give them rent credits. We don't do that, right? The above and beyond the rent, they would pay additional money towards the down payment, which is paying down their equity. Once they hit the 20% mark, we'll say in 2 years or 3 years or 5 years, whatever you want, you'll convert them to owner financing. Because see, you have a subject to loan here for 22 years or whatever amount of years, right? It's a long term. So if you don't want to keep replacing people in this house every 2 or 3 years, right? Like, for example, I know investors that go overseas and they're traveling, right? Suppose you wanted to sell this to a doctor, right? You could set it and forget it for the doctor. So what I would do is I would buy the property subject to, I would close with the agent, I would get the beneficial of interest signed, I would get the doctor to pay the money, and then as part of my agreement, tell him I will put somebody in the house for him. Or put somebody in the house for them and then sell the whole package. Like, I got this person, they have a lien, they have a lease option for 3 years, but if you want, I can convert them to a land contract and they can stay in for 20 years if you want. Understand?
Yeah, because on the land contract, they would be paying toward acquiring the deed. It's not just leasing anymore.
A land contract or an agreement for deed or whatever you call it in your state is a mortgage without passing the deed. So they're paying on the property, and once the property is paid off, they get the final deed.
So at that point, their payments are going toward paying off the equity, just like a mortgage loan. Okay. It's not just leasing. That's the point.
You could put cash flow in there. Like you could say, okay, the mortgage payment is $1,800 and you're only paying the mortgage company $1,400. So you can have $400 a month cash flow, but it also gives the seller relinquishes the principal pay down because the buyer now gets it.
Right.
But realize, based on our other podcasts, you still get depreciation, you still get the interest write-off, you still get all the tax write-offs because you still have the deed. So either you owning the deed because you want to keep long-term portfolios and you don't want to keep turning them over 3 years, or you want to sell it to a doctor or one of the, somebody that has the money to put down, then you can do that for them.
Yep.
Right? So you tell them, I'll put you on a lease option until we hit a threshold because you're kind of testing them out to see if they're going to pay. You don't want to do, basically what I'm telling you is don't do the land contract right away because you want them to prove to you that they're going to pay and that they have the money and they're going to come up with the chunks of dough that you want. Because if you do a land contract with them, you could still evict them and everything. But I'd rather put them on
that sounds harder. Yeah, it sounds easier to, right?
Yeah, I would want to put them on a lease option, hold that over their head, say, hey, you're in probation.
Yeah, it's easier to evict them on a lease than a land contract. That's a higher level.
And we're going to ask them to pay what you labeled it a pre-mortgage payment until we can give them a mortgage.
Mm-hmm. Sounds official that way. You know, if you name things, it makes it sound like it's a thing.
Now, when you do this, you're the bank.
Capital letters.
That's right. Now, when you do this, you're the bank and you have natural passive income.
Yeah.
So the point is you can get more money when you convert somebody from a lease option to owner financing or seller financing. And all we're doing is just switching it from a lease option to a land contract or an agreement for deed to switch it from lease option to seller financing.
So here's my takeaway. If any of that sounds confusing, the good news is there's a lot of exit strategies on property. And that's an important point because if this happens, if that happens, if I change my mind, if, you have a lot of exit strategies that you still make money instead of losing money.
Well, the thing that bothers me the most is when a rookie looks at a property and they want to. So, first of all, we teach what Nelson Rockefeller said. The way to build wealth and keep wealth is to own nothing and control everything. Well, that's the slot deal, that's the option deal, that's the rent to own, which is all sandwich lease options, and you don't own anything, you just control everything. Which is how we figured out what creative real estate is. Creative real estate is owning none of it and controlling all of it.
Which is a good way to start when you're new because you're not too sure what you're doing and it's not risky.
But then the question comes up, like what happens if you buy it subject to, or rehab and flip, or seller financing, you get the deed in your name. It's not a quick exit, and you're all panicky about like, how do I get rid of this property if I can't pay for it?
Yeah.
And what I'm trying to do is open your thinking today to, even though the deed's in your name, there are plenty of exit strategies, especially with subject to, because you can sell you can assign the beneficial interest to the deal from the beneficiary. You can assign that interest to a wholesaler, which I've never, ever heard anybody ever say that before. This is the first time I'm saying it public, other than behind a paid portal. I've charged thousands of dollars to teach people how to do this. I have a 6.5 hour webinar I did on a Saturday morning for my coaching clients one time to go through all the details on how to do this. Right? And you'll be able to see how to get that if you click on the link in the chat, or you click on the link in the description. Okay? So all I'm saying is that people think they're stuck with property because they don't know how to think outside of the box. Okay, so creative real estate is not only easy to sell, it's not only creative when you buy it, but it's creative when you sell it. And the best thing in the world you can do is assign any property to anyone. You can do that with options, or you can do that with land contracts or an agreement for deeds. It's very simple to do if you understand it. Okay. All right. I hope this helped our listeners, and I hope I held up to my promise in the description. I think I did. Right?
Oh, I think so.
Yeah, good.
You had my attention. We've talked about this a few times, but it was a really good review of everything and these additional points, and that I hadn't heard. That last point, I don't think I've heard that from you.
Right. So anyways, please make sure you subscribe to us wherever you're watching us or listening to us. Make sure you like us. Make sure you leave a comment. And if you have any questions, you go to flippinghouses4rookies.com and put in a support ticket. Go to WhatsApp Messenger and look for Let's Talk Real Estate. More importantly, please make sure you click on the links that I put in the descriptions and go check them out and see if they can help you. Okay? And with that said, we are off to podcast number 403, Peter. So we do these weekly, so I will talk to our listeners in a week. Art said, well, Art's happy. Art said, thank you, Bill. Great. Bill and Pete, great info.
Welcome,
Thank you for
Art.
being here, Art. Thanks for the support. And we're over and out. Have a good week. Flourish and prosper.